My name is Michael Duke. I'm an investor and analyst. I regularly review interesting stocks and investment opportunities here on my YouTube channel. I'm also a contributing author on Seeking Alpha, where I cover what I believe to be compelling investment opportunities in the equity markets. So, if that's something that interests you, and you want to see more content like that, then please like this video, subscribe to my channel, and if you're feeling frisky, hit the notification bell just so you get notified every time I upload something new, which I do quite regularly. So, anyways, today I want to talk about one of my favorite stocks, and more specifically, this is a real estate investment trust or REIT. I think that this stock is highly misunderstood by the market today. And I'm going to go into the reasons why I find it so compelling. I'm going to talk about the growth story, the narratives underpinning why this may or may not be a very, very strong investment for your portfolio, as well as a deep dive into the analysis of the financials, their capital structure, balance sheet, and also some of the risks, because this has historically been, and I foresee it to continue to be, uh, further up on the end of the risk curve in terms of investments out there. But as they say, with high risk comes high reward. And as always, I will also be doing technical analysis on the long term stock chart, as well as providing my grade for the stock and some potential other risk parity trades to enter into to hedge your bets a little bit with this one. So, without further ado, let's get into it. So, the company is called Innovative Industrial Properties Inc., ticker IIPR. And just the background on this company, let's see what window I'm on. This is an internally managed real estate investment trust, and it's very important, at least from my opinion, when we're looking at real estate investment trusts, that we identify if it's internally or externally managed. And I would say, as a general rule of thumb, that an internally managed real estate investment trust is, all other things being equal, going to be better than an externally managed real estate investment trust. And the reason for that being that when it's internally managed, there's something in the real estate industry that this concept of asset management fees. In other words, each commercial real estate deal typically will have what's called a sponsor, or really the manager of that real estate investment. And the sponsor is typically entitled to asset management fees for managing that investment. And if that can be extended out more broadly into an entire fund of real estate investments, or a REIT, whereby the holdings of that fund or REIT are managed by a externally managed party. And an example of that I can think of off the top of my head is one of the two farmland REITs that I'm aware of that are publicly traded: Gladstone Real Estate Investment Trust, or Gladstone Land Trust, I think is what it's called, ticker LAND, LAND. That's externally managed by Gladstone, an alternative asset manager. So on Land's financials, you'll see a line item for management fees that is an expense, and that flows out of that entity and goes to the sponsor. Whereas a internally managed real estate investment trust like IIPR, they are entitled to the asset management fees. And that is a revenue driver that flows to their entity. So, why do I know all this? Well, I worked for 4 years at a private equity real estate investment firm. I worked on the acquisitions desk. I started as an analyst and worked my way up to the acquisitions director there, and was involved in the sourcing and acquisition of over $100 million of real estate, primarily industrial. So I'm very familiar with the industry, and it's my knowledge of the industry. I do know a few things that knowledge that I have is part of the reason why I feel like I understand this investment better than a lot of other investments that may exist on the market. Is an internally managed REIT that exclusively invests in cannabis related real estate. It says here on their website, the leading provider of real estate capital for the regulated cannabis industry. And they're not a mortgage REIT, but we'll kind of talk about why they market themselves as the provider of real estate capital in a second. So it's actually very crucial to the thesis. But you see here, all of the blue states are where they have properties. You notice some of these states don't even have a recreational marijuana. Legal recreational marijuana, the first that sticks out is Texas. It is medically allowed. Florida, they just notably struck down a measure on the ballot in the recent election to make it recreationally legal, so on and so forth. So there's 108 properties total, comprising 9 million square feet across 19 states, 30 tenants, which is not a lot for that amount of square footage, but we'll talk about that later. So this company was the first of its kind, first to market, and is the market leader in cannabis real estate. And now I want to talk about the narrative of this investment, why I think it's such a great story. So let's first talk about the cannabis market as a whole. This is a basic report on Grandview Research. It shows the estimated growth of the cannabis market. And this is the legal cannabis market, to my knowledge, growing at a 12% compound annual growth rate. So that is above market average when we're talking about the stock market as a whole. So, in theory, all cannabis related investments should be more growth oriented than value oriented, given that it's a new, very fast growing industry. And this stock has really been no exception to that. Typically REITs are, I don't know the exact numbers on this, but I would wager that they probably have lower volatility than the market at large. But we see here the stock started trading in 2016, and just in the price return alone has handedly outperformed the S&P 500 in that time in price return alone by 2.5 times. And it's well off of its peak that was seen in late 2021. And of course, as we always want to do, because this thing has spit off a bunch of dividends over the years, we see here that the total return is far greater, about 60% higher than the price return. So this stock has crushed the market, even despite really being in a bear market for the last 3 years. Still has crushed the market. So this stock is a high beta, high risk, volatile growth stock, which every long-term portfolio, especially ones that are dividend focused, I know dividend investing is a thing these days. Every stock or every portfolio like that, every portfolio needs a few positions that are high beta, that are more volatile than the index, just to ensure a fair likelihood of market performance or outperformance, ideally. So here's the secular growth of the cannabis industry is a major story with this stock. And along with the cannabis industry, there's because cannabis is on the DEA schedule of illicit substances or controlled substances, financing for cannabis enterprises or businesses is very limited. Now, in recent years, it's become more available. But if you are a dispensary or a grower legally operating in a state where you can, such as California and Washington, so on and so forth, you will struggle to find financing partners. Legitimate banks, big banks, don't want to touch that kind of stuff. Maybe there's a local credit union that will, but the interest rates are going to be higher than a standard retail business. So that fact has very much contributed to the rapid growth of this company. And the reason for that is because of their sale leaseback program. And so, again, when I worked in commercial real estate acquisitions, every now and then we would perform a transaction that was a sale leaseback. And basically, for those that are unfamiliar, what that means is that a business, an operating company, will own a piece of real estate that they occupy and are operating out of. And yields on real estate, might be anywhere from 5 to, in the most risky sense, 12%, let's just say. And most businesses out there can achieve higher returns than that on invested capital. And really, if businesses have a lot of their balance sheet tied up in the real estate, then they might be handicapping their growth somewhat. Because if they monetize that real estate by selling it and leasing it back from the buyer, then they theoretically, in most cases, are able to generate higher growth and higher returns on the equity on their balance sheet. And so, in the cannabis industry, given that there's a limited availability of financing, that concept is somewhat supercharged and on steroids because these businesses, they're in theory cash rich with low leverage, and they are in dire need of growth capital. And there's, plenty of equity capital on the market for these businesses to access, especially nowadays. Over 80% of American adults believe and support federal rescheduling of cannabis and marijuana from, I can't remember exactly what the scheduling is, but to classify it as a more benign substance. So more and more investors are willing to provide liquidity in form of equity to the cannabis industry, but financing is limited. And that's where this sale leaseback program becomes such a value creation driver for a cannabis operator. So let me just explain how this might work. And I'm just going to make it up. This isn't a real example, but it more or less is effectively what they're doing. And you can verify that by looking at their website. So it says right here, we act as a source of capital to these state licensed operators by acquiring and leasing back their real estate across all product types: cultivation, processing, distribution, and retail. These transactions allow for the opportunity to redeploy the proceeds into core operations, yielding a higher return than they would otherwise get from owning real estate. So that's exactly what I said. So the scenario that I'm talking about is, let's say that you have a cannabis cultivation enterprise whereby you grow it and maybe you process it as well. Maybe you're completely integrated to where you have cultivation, processing, distribution, and retail. You've been successful because the market is growing again at 12% per year, and you're one of the few players in your market. So you've got this rapidly expanding business that's flush with cash. You need real estate. You need lots of real estate to cultivate anything. Cultivation of agricultural products is a land intensive business. Processing, distribution, retail, all of that. You need a real estate footprint to do that. Let's just say that you've built up enough of a cash position in your several years of business that you need to acquire real estate, and in your area of operation, there just happens to be a piece of vacant real estate that is available. And let's say that that vacant piece of real estate is $1 million. There's a 100,000 square foot warehouse for $1 million. Those aren't realistic numbers, but we're keeping it simple. So you go out and you buy that real estate, okay? But in order to retrofit that for what you're doing in it, for the cultivation and processing, I mean, you can see in this image here the amount of infrastructure required to cultivate these plants. You have these large enclosures, a bunch of lights there's a bunch of electrical work, the fan. There's a lot of investment required in that $1 million piece of real estate in order to get it set up. So you could take the cash on your balance sheet and you could invest in it, or you could turn around to a bank to get a loan. Well, we know based on what I was saying earlier that getting a loan is going to be challenging, right? So instead, what you do is you go to IIPR, you go to the preferred provider of capital to the real estate industry, and you say, "Hey, IIPR, I will sign a 15-year lease at a market cap rate," and market cap rates for these buildings are 400 basis points higher than a regular industrial building, at least. So it's a riskier investment. There's no financing. The buyer has to be compensated for more risk because of the business underlying it. The cannabis business is more risky for the landlord, therefore they have to have more yield. But you say, "Hey, I will sell this to you at a 12% cap rate, let's say, and I would like you, Mr. REIT, Mr. IIPR, to provide all of the capital required to retrofit the building. And then I will lease it from you for 15 years in a complete pass through triple net structure where I pay all the property expenses, so on and so forth." Well, what that happens is, again, I'm just going to make up numbers here. But let's say that you, as the cannabis operator, the economic value that you will create by getting that building up and running and performing and ingrained in your operations will generate $600,000 of profit per year, or more than that, but at minimum 600,000. So at a 12% cap rate, the value of that building on a 15-year lease and whatever improvements there are is $5 million. That's the value of that real estate now with that lease attached to it. This is how commercial real estate works. It's not like a house, it's based on cash flow. So basically what that means is these operators are able to go scoop up real estate, and if they're running short on capital to fix up the building and get it ready for their operations, they can turn around and basically borrow $5 million back onto their balance sheet and pay it over time with $600,000 of rent. That's how the math works out here. So do you see, hopefully, if you're watching this video and still watching up to this point, you see how this sale-leaseback program is actually providing liquidity potentially to cannabis operators. And that's why they're saying that they are a capital provider. In an ancillary sense, they also are providing real estate, which is a necessity for a cannabis enterprise. So that the financing piece being limited in this industry creates the opportunity, or creates a large piece of the opportunity for this REIT to grow very quickly. And the fact that the cannabis industry is growing at an above average rate, at a low double digit rate per year, creates the potential for massive growth. And that is why over the history of this company, it has gone crazy in terms of price appreciation. It's been volatile, but it's grown quickly. And that's because it's a financing vehicle for companies that don't otherwise have access to the financing. So another opportunity, another reason why this is an interesting but also misunderstood stock is because REITs right now are in a bear market, including this one. And the reason for that being that interest rates, of course, have gone up a lot over the last few years. Real estate is a capital intensive industry, and interest rates going up, in theory, decreases the value of all commercial real estate because the cost of capital is higher, and it depresses yields on existing leases and makes the next outlay of capital require a higher yield to be sufficient and economically viable. But Prologis, IIPR, and Stag are all industrial REITs. If we look, I mean, even over the 3-year clip you see here, every single one of these stocks is in a bear market, especially in reference to the S&P 500. Every single one is still in a major drawdown period. And over a 5-year period, every single one of those stocks has underperformed the index. So real estate, it's not necessarily undervalued, but the increased cost of debt has depressed the valuations of REITs in this market. Why that's important for IIPR is because as a part of the cannabis industry where financing is limited, they also do not have the ability to access debt like other REITs can. Now, of course, they can issue bonds, but they've opted to keep the majority of their capital stack with either just equity, self-fund using cash, or they do have one, I think several issues of preferred stock. But, a typical commercial real estate building, you're going to put 35% down, have a mortgage for 65% over a 25-year amortization schedule. So the depressed valuations of REITs, of course, that beta of the sector has impacted IIPR, and it's in a much more severe bear market from the all-time high than the other REITs. But I think that that's somewhat unjustified. And it's not just because of interest rates. There was also a lot of negative sentiment around the cannabis industry around, this time here, because there was a lot of news reports about illicit cannabis being able to be sold at lower prices and better margins because they could undercut the market without the excise sales taxes that the states were deriving from the revenues. So there was a lot of negative sentiment between interest rates and market dynamics that just crushed this stock at one point in time. So moving gears a little bit to what I was saying a few minutes ago, the reason that I think that this stock is undervalued, even compared to maybe some other REITs out there, is because they have a drastically different capital position than other REITs in their industry. In fact, on the most recent earnings call, the CEO said, and I quote, "We continue to have what I think is one of the most resilient capital positions among real estate companies generally." I very much agree with that because only 11% of their balance sheet is debt. And the majority of their assets are tied up in the property, and they have a little bit less than 150 million in cash. They only have 300 million in debt versus that 150 million of cash, which, I mean, that's an insanely high level of cash to debt ratio compared again to, and again, I like Prologis. I think it's a good stock. Prologis has 780 million of cash versus 32 billion of debt. This company is way more highly levered than this company is. So as far as, and I would urge my viewers out there to go look at REITs that they like and do a similar analysis. Realty Income has 400 million in cash versus 25 billion in long-term debt. That's a stark difference. So in a lot of ways, this company is in a much better capital position than other REITs, and it is a byproduct of the industry that they're in, and the fact that accessing debt is not as easy. So while the market has somewhat punished this company for its limited access to debt, the byproduct of that is that they actually have a very, very healthy relationship with it. So you see here, total debt as a percentage of capital. Seeking Alpha gives this stock an A plus. Again, we're looking, A plus at 13.3%, the industry average being about half. And then net long debt versus assets, single digits net long debt versus 41% industry average. So this is a REIT that is fundamentally much less sensitive to interest rates than the other REITs are, because when they go acquire a property, they aren't really using the debt, and therefore they're not sensitive to it in the sense that the other REITs are. And so I think that that's a huge mispricing and inefficient mechanism that the market has placed on this company, is that it's punishing it like all real estate. And it some of it is warranted because the residual value of their buildings, in theory, is somewhat lower than before because of the cost of debt, if it wasn't used for a cannabis purpose. But we'll talk about that later and why I think that that's not as big of a risk as it seems. So that was quite a long overview of this company, but I think that it's very misunderstood and very interesting. So let's next look at some of the valuation metrics. And first, I'm going to go into the yield of the company. So this is one of the, higher yields that I consider to be safe on the market today. The current dividend yield is just a shade over 7%. If we look at the all-time chart, it was trading about 15, 16 months ago or 18 months ago at a double digit yield, and has since, come down quite a bit. But after the election of Trump, it sold off quite a bit. And so it's hovering at 7%. So in terms of a dividend, from the dividend yield perspective, it is trading at a fairly high historical yield still. But the dividend growth has been astronomical. In fact, if you would have bought this stock at IPO, then your yield on cost would be at 41% today. And that's because they have rapidly grown their adjusted funds from operation, and as a result, their dividend. In fact, the first dividend they paid was 15 cents per share. Today it's $1.90. So I can't do that math in my head. All I know is that is over 10x in terms of the payout from a single share. So I challenge you to find another real estate stock, another REIT that has that level of dividend growth over time. One thing that you will notice if you're paying attention is that the dividend growth has slowed substantially in the last 2-ish years while it's been in that bear market. And that's just because management has signaled that they're being more cautious about outlaying capital. And I think that that's a prudent capital allocation strategy. But what we're looking at is a stock that's grown very rapidly from an industry low cost of capital because their yield was so low. Again, the equity yield, the dividend yield of a REIT is its equity cost of capital. And most REITs don't have 2% yields. So it had a super low cost of capital, a lower than other industrial REITs at one point, and they were acquiring properties that had 3 to 4% more yields on the cap rates. So they had this massive spread on their cost of capital versus the yield that they were receiving for investing their equity dollars. And that spread has closed substantially, but there's still a healthy spread. And this company is still able to outlay capital accretively. And I'll walk through the math of that later in the video. But what we are looking at is, if you are looking at this stock, I would not expect, it would not be reasonable to expect that you see the level of dividend growth that has been seen. The 5-year compound annual growth rate being 28%. I would not expect to see that level of growth going forward. That being said, it has increased by 8.3% over the last year. So slow growth for this company, still pretty damn good. Okay. Very compelling. So it is trading not at a historically low yield or high yield, but a very, very healthy yield compared to the history of the company. We already took a look at the balance sheet, so I won't go back into that. Let's talk about why, despite having an elevated cost of capital, now that their shares are at 7%, doesn't necessarily mean that they can't accrete funds from operation in the go forward. Okay, so I've made this very crude analysis here, and I expect to be roasted for my spreadsheet formatting skills, but I'm going to walk through it step by step so that it's understood. I did this very quick and dirty before I made this video. So here's the deal. The concept of what we're talking about is, in order to create acquisitions, to create a pipeline of deals that acquire, the whole purpose and concept of a REIT is that they're highly leveraged and they don't carry a lot of cash. So in order to accrete more adjusted funds from operation per share, they sell more shares on the market and take the proceeds from the share sale and put that as the equity slug to purchase the next property along with debt that they've issued on the bond market. Just like you would if you had money to buy a rental house, except you don't necessarily have a certain yield on that equity that you're putting down that you're adhered to, whereas REITs are legally required to distribute a certain amount of their cash flow. Anyways, I'm getting a little ahead of myself. What's important to understand when it comes to REITs is the implied cap rate, and that's simply their NOI versus the value of the real estate. And I don't know if this is like the industry standard of implied cap rate calculations, but it's what makes sense to me versus their rent income minus the property expenses. So I'm not accounting for depreciation. I'm not accounting for SG&A here. I'm simply doing this number minus this number divided by this number. Okay. So what that does is it implies that the cap rate of their real estate at cost is double digits. If you wanted to achieve a double digit cap rate by buying a rental house, you would have to buy something that is old, very old, and is in a low quality neighborhood with more crime in a Midwestern town. Maybe that fits your profile, maybe it doesn't. But most REITs do not have implied cap rates in the double digits. I would urge you to do this same analysis for your favorite REIT investment out there and compare. When I worked in real estate investment, we looked at industrial properties. There was an openly marketed property in Washington State that we found out about and we looked at, that was it was a piece of cannabis real estate. It was a large warehouse that was leased to 3 or 4 tenants. And the reason it caught our attention was because of the double digit cap rate that it was openly being marketed at, whereas most of the properties that we were used to looking at had, at the time we were looking at this, cap rates that were in the 6 and 7%, maybe even lower. So there was a 5-point spread on the cap rate, and that makes sense. Again, higher cap rates means higher risk. So, anyways, I did the analysis on this building, did the discounted cash flow. It was a screaming deal, slam dunk for us. And immediately I became fascinated with cannabis real estate. And this really started my fascination with this sector of real estate. Long story short, we could not acquire it because, I mean, it was like $30 million and we couldn't purchase it with debt, which is what we did. We didn't have the sufficient capability to be able to raise 30 million because our cost of capital was too high on that equity to be able to do it. And a cash buyer came in and paid more than it was listed for. This was in 2022 or maybe late 2021. And they paid, what was at or near a double digit cap rate for this piece of real estate. It may have even been this REIT for all we know. But anyways, that immediately opened my eyes to the value creation occurring in this sector. So looking at this implied cap rate, that makes sense to me. That being said, they were acquiring these properties when cap rates were lower too. So this implied cap rate, it's conceivable to think that if they were to go buy a new piece of real estate today, that the cap rate would be higher than their current implied cap rate. That makes sense. So in this analysis, what I'm assuming is that in order to accrete value to adjusted funds per share, they have to acquire things at a 12% cap rate. So I've just kind of done the math here. If a property is $10 million at a 12 cap, that means that its net operating income is 1.2 million. That accretes 1.2 million to their adjusted funds from operation. They have 28.3 million shares outstanding, give or take. That would accrete 4.2 cents annually to their AFFO per share. So think about that for a second. I'm not even modeling them selling more shares and diluting existing shareholders to pick this up. So do they have the ability to actually acquire properties without selling shares? I believe so. So again, if we looked at their financials, they had 147 million of cash. This is a very crude analysis, but I hope it makes sense. What I'm modeling is kind of like the blood cash budget of this business. And it's not perfect. I urge my viewers to do their own and share it and, kind of check my work here. But this math makes sense to me. So in the prior quarter, they had $76.5 million of revenue, and that includes fees and rent. I think 400,000 of fees and the remainder was rent. Their dividends payable at the current per share, again, $1.90 a share times 28.3 million is roughly 54 million of dividends that they will pay. Their expenses in the prior quarter, they had 7.3 million of property expenses and 9.3 million of overhead. So, sales, people in the office space, utilities, whatever. And then they paid $1.7 million in interest, right? And they basically have 2 months worth of cash in the bank to be able to pay those expenses. If that doesn't sound like a lot, it's a hell of a lot more than other REITs do. Okay. So here's the idea behind this analysis. So in a month where they are grossing $76.5 million and they have 72 million of essentially liabilities, then they're gonna gain $4.5 million of cash to their balance sheet. So this current amount of cash that they have, they don't really need to dip into that cash in order to pay their bills or anything. If anything, their cash balance is going up. So theoretically, they could invest a significant amount of the cash that they have in a new acquisition, right? You see where I'm going with this? Without needing to raise shares and without it significantly harming their operations. So I'm being pretty conservative here, but I'm basically taking the analysis I did over to the left, monitor back up. I'm taking this analysis here and I'm creating a table here for every $10 million that they outlay at a 12% cap rate, how much adjusted funds per share they accrete per year. Again, we're not diluting the shares here because we're doing what's called a self-funded acquisition. We're just taking the cash on our balance sheet to invest. So this is the adjusted funds from operation share accretion of $10 million and the growth rate annualized. So in other words, what this means is, in theory, assuming that they can acquire properties at a 12% cap rate, which I believe that they can. In fact, it might even be higher than that. They can outlay a third of their cash, roughly a third of their cash, is 50 million at a 12 cap, and they would instantly grow their adjusted funds from operation by close to 10%. And let's also think about the fact that the cost of equity capital right now, if they were only to use equity to fund an acquisition, is 7%. So if they decided, yeah, you know what, we're not going to dip into our cash, we want more liquidity, and they were to issue shares to purchase properties at a 12% cap rate, and they had a 7% cash outflow to finance that acquisition, then effectively what that would mean, again, I'm kind of messing with the numbers here, but effectively that would mean they have a 5% spread. Then what that means is if they issued $50 million worth of shares, they would accrete to adjusted funds from operation. So this REIT does not have the issues that other REITs have in that they have enough cash to self-fund enough acquisitions in a short time frame to grow rapidly. It also means that they still have a spread above their cost of capital. The analysis I just showed you is overly simplified. It's a little bit more complicated than that, but you should get the idea. They have a low enough cost of capital. It's high, but it's still low enough relative to what their investing yields are. They have a low enough cost of capital where they can issue shares still and accrete a large spread over their cost of capital. So what that means to me is that this REIT is advantaged from a cost of capital perspective. This REIT does not have the same challenges. And to make this analysis more robust, perhaps it'd be helpful if I did the exact same analysis on another industrial REIT that isn't cannabis focused, just to show you a comparison. I'm not going to do that for the sake of time. Maybe I'll do that in a different video if enough people want to see it. But I believe that this stock, this REIT, is a screamer because it just screams continued value creation. So you're probably wondering, well, if all that's true, then why are they not growing that much? Well, they are. In fact, if you see, this is earnings per, no, this is FFO. So I can't do the math in my head of what this weights out to, but this is like a mid single digit growth rate. So what we're seeing is that they're actually being more conservative than they could be with their acquisition strategy. And I think that that's actually pretty smart. But ultimately, what you should surmise from this analysis is that that dividend is safe. And their earnings, their revenue in the most recent quarter, it dipped a little bit because of some tenant struggles, and that's one of the risk factors. We'll go into risk factors in a second, but ultimately I believe that this dividend is safe, and if they were to cut the dividend, it would not be significantly, because again, they can continue to accrete value in this environment. So let's talk about the risks. Obviously, there's the fact that cannabis is a scheduled controlled substance federally, and that's a risk. As long as that exists, this stock will not trade at a premium value if as long as that's the case. And so any sort of time that there's like a regulatory or legal news event, it may move the stock 10% one way or the other. In fact, that's what happened. You saw leading up to the election that the stock traded, it went up a lot. In fact, at one point, over the last year, it was up 70 something percent. When the election happened, the stock dipped over several days, about a week, by 30% ish. And there was a lot of, I think, betting in the market that, Kamala Harris was platforming on the federal reschedulization, legalization of recreational cannabis. She didn't get elected. The market reacted very negatively to that. And then they released their earnings report 2 days later. Their revenue was somewhat lower, which was a negative. The market did not react strongly to that. But I think that that's all noise. In fact, I think the fact that it still has the scheduling status that it does, again, that creates the value creation opportunity for this. So I think that this stock is the ultimate contrarian bet. If you believe that the cannabis industry is a major growth story over the next decade, which I do, but you also want to hedge your bets a little bit on how long it's going to take for this reschedulization thing, buy this stock. Don't buy the operators who are actually selling the product, because those stocks will benefit much more from rescheduling than this stock will. However, this stock will benefit both ways. It'll benefit if it doesn't get rescheduled, because they'll be able to perform these sale-leaseback transactions. They'll be able to benefit when it does get rescheduled, if it does, because the yields on their real estate, the implied cap rate, they're sitting on real estate that they acquired at a cost of 11%. Think about that. That real estate, if it doesn't have the legal risk of cannabis underpinning it, it's worth a 7 cap. It'll go up by 40 or 50% overnight, the value of their assets, right? So I really like this investment because I think it combines the like riskiness of cannabis and the growth story and kind of hedges somewhat about how long it'll take to play out the way that people might want it to. So really what I see as the main risk here with this stock is not the legal, like the schedule, the SAFE Act, the Banking Act, the rescheduling. I think that that is almost a positive for this stock and it reinforces the value of it. The main risk with this stock is the tenant base and the tenant concentration. Now, again, these tenants here are really the best in breed that you can get in the industry. PharmaCann, Green Thumb, Curalife, Trulieve, Cresco. These are, to my knowledge, it says here 62% public. Some of these tenants have had issues, both cash flow wise and legal wise. All of these stocks, if you were to look at their charts, they're, I would imagine, very depressed right now, or at least they were a year ago when I first looked at it. You see here in this rent roll here, the percentage of square feet that's rented, and not even square feet. ABR stands for annualized base rent. So the top 10 tenants make up 76% of rent. And the top 3 tenants make up a quarter of it. And then you've got like another 17%. So the top 5 tenants make up almost 40% of that rental revenue. So that is a risk. And that is a reason why this stock probably should trade at a much higher yield than other REITs, is it has tenant concentration risk, which you don't want in a REIT. But I believe that it's a good calculated risk to make because, again, these leases are so strong. In fact, let me see where I can find right here. Structured long-term cash flows. This is from the investor presentation during the last earnings report. Generally 15 to 20 year lease terms. Lease is generally subject to parent company guarantees covering operations throughout the United States. So this business, because it has such a strong recourse on the operators, that it literally has a guarantee that covers operations that are inside the country. This landlord, like, can you imagine if your landlord had a claim to, if you didn't pay rent, they didn't just have a claim to what you owed, but they could strongly enforce that to the point of withholding your earnings across a lot of your income. But the idea is, because IIPR is effectively serving as a lender and liquidity provider, they have been compensated for that risk adequately, and they have very strong claims to the underlying cash flows of these businesses. So again, if you're going to invest in cannabis, I would strongly urge you to take a look at this company. So as for my grade on this company, I rate this company as a strong buy, such a strong buy that it is a buy with both hands buy. I have roughly 8.5% of my portfolio in this one stock. When it dipped here, I purchased more up here because I wasn't sure who was going to win the election, and I knew it would probably rip if Kamala won. I wanted to hedge against that somewhat versus other positions in my portfolio. It dipped quite a bit. I bought a lot more in the dip. So I have an overweight position in this stock. It's risky. Part of the reason that I'm comfortable putting so much of my money in this stock is because I feel like I understand it with a lot of depth. And I urge you to do your own research so that you can get comfortable as well. But hopefully, what I'm talking about here makes sense to the point that you understand more about why this stock, this REIT, is a lot different than other REITs and why it's very compelling. So I think that this is a strong buy. If you did want to hedge your bets a little bit, then you see here this stock traded with the beta of the market. In other words, it has a beta greater than 1. So when the market goes up, this stock goes up. When the market goes down, this stock goes down. This stock is correlated with the market, and it's more volatile than the market. So if you want to hedge your bets a little bit, then you should look into companies that are somewhat inversely correlated. The first few that come to mind are agricultural producers, and I'm just going to use this one as an example here. So Nutrien is a agricultural product. They produce and sell fertilizer products. They're the largest worldwide, I believe, or one of the largest, and their main revenue stream is potash. They're based in Canada. So you see here, this stock, right before the broader market started selling off, this IIPR sold off. Well, what happened to Nutrien stock? It went up quite a bit. In fact, it went up about 50%, more than 50%. Now, Nutrien has underperformed both of these stocks really over the last 5 years. But if you were holding this stock and this stock, again, I can't combine those prices together and chart them versus the index, but I would wager that they've also drastically outperformed the index with a superior risk adjusted return. So I would urge that you hedge a little bit by investing in something that's somewhat uncorrelated. Now, I'm running out of time here, so I'm just going to do a quick technical analysis on the long-term chart. You see here, the stock traded with a very, very strong uptrend for most of its history. Broke through that, found some support here. But what we've seen lately is that it's been in an uptrend. Again, it's broken down below the trend line, but it is trading here at a prior level of resistance. And the last few sessions, it has been bid up somewhat. So I don't think that the chart looks overwhelmingly bullish. However, I do believe that the recent sell-off provides a compelling buying opportunity. So yeah, that's pretty much it. This has been a very, very long video. Hopefully you found this to be instructive. I really like this stock and think it's a compelling investment. However, it does not come without its risks, and it is very volatile. So be sure that if you're going to enter into a position in this stock, that you're prepared for that volatility and have other positions that can offset it somewhat. What you're doing here is you're capturing a very high beta, high growth type of potential with a relatively safe dividend and payout. So I like that. It fits a lot of what I'm doing with my investment strategy. And hopefully you found this helpful enough that it might inform your portfolio decisions as well. Thank you so much for watching this video. If there are stocks on the market that you're interested in that you would like to see me cover, I'm always looking to do more analysis and do more videos like this. I already have a huge list of things I'll cover next, but I strongly urge you to comment below and give me some feedback on this and name other opportunities that you'd like to see me analyze. Anyways, thank you so much for watching, and I hope you have a good day. I'll see you next time.